Welcome everyone to today's webinar. I am Maggie Moran with Becker's Hospital Review. We will begin today's webinar with a presentation and panel discussion, and we'll have time at the end of the hour for a question and answer session. You can submit any questions you have throughout the webinar by typing them into your control panel in the space labeled "Enter a question for staff" and clicking send. We are looking forward to hearing your questions. Additionally, in about a week following the webinar, we will be sending you a copy of the presentation to the email you used to register. At this time, I am pleased to turn the floor over to Betsy Field to begin today's presentation.
Hello, everyone, and thank you so much for joining us. My name is Betsy Field, and I lead our Willis Towers Watson healthcare provider and tax-exempt industry teams for Talent and Rewards. I'm joined by Susan Soulis, a managing director in our executive compensation practice who specializes in executive compensation in the healthcare industry, and also Paul Weber, a consultant in our retirement practice and actuary who co-leads the benefits area for our healthcare provider and tax-exempt industry teams. To get started today, we will begin with an overview of the Tax Cuts and Jobs Act provisions which impact executive compensation at tax-exempt organizations, which includes many healthcare providers. Susan will then take us through how the potential excise taxes are calculated and some plan design considerations. And then Paul will walk us through the options you have if you determine it makes sense to modify any existing awards or arrangements that have not yet vested and been included in taxable income. Finally, we will discuss communications considerations and open up the lines for any questions you might have. Next slide, please. On December 22nd, 2017, President Trump signed the Tax Cut and Jobs Act into law, which overhauled the tax code, including provisions affecting executive compensation at tax-exempt organizations. These provisions apply to taxable years beginning after December 31, 2017. So we're going to start with just an overview of the key issues or portions of the regulations that impact you from an exec comp perspective. The first thing is you're going to hear us talking a lot about covered employees. So covered employees include current or former employees who are among the 5 highest compensated individuals in the organization or any predecessor organization for the current tax year or any prior tax year beginning after 2016. So I know that's a mouthful, but in practice, what this means is as you're going into this year, depending on whether you're a calendar year, fiscal year or not, you could have up to 10 covered employees for 2018. So you'd have your top 5 highest compensated based on taxable income for 2017, and then any others up to 5 who are in the top 5 for 2018. So that's assuming that there's absolutely no overlap in the top 5 between those 2 years. So therefore, in 2019 and each subsequent year, the number of covered employees could grow by another 5 individuals. This does include former employees. So if they were covered employees while active and are receiving post-termination compensation in excess of $1 million per year, that compensation is taxable, then those individuals are going to be subject to these excise taxes too. So the key takeaway here is once a covered employee, always a covered employee. Next slide. So the other point we want to make is that this definition of covered employees applies to each entity separately. There isn't an aggregation rule. So if your organization is a single legal entity, for example, you may be filing, just that one Form 990 for the entity, you will only have up to 5 per year. However, a lot of our clients have multiple organizations that have separate tax numbers within. So each of those separate tax organizations, not taxable, but each of those separate organizations will have to determine their 5 covered employees. Okay? So, for example, we said, you know, if you have an entity A and entity B, and there's separate entities filing separate Forms 990 within a controlled system, the top 5 at each entity are considered covered employees. So if each of these top 5 earns more than $1 million, the excise taxes will be payable on the compensation for all 10. I also want to remind you that on the previous slide, we talked about predecessor organizations. So if moving forward, you decide that, you know, there's a reason for you to maybe condense some of those organizations, those people that were covered employees under the previous organization, that predecessor organization, would still be considered covered employees going forward. Okay, so let's talk a little bit more about what the potential excise taxes are. Next slide. Okay, so we're going to talk about these in 2 different buckets. The first is the excise tax on pay exceeding $1 million. So the legislation imposed an employer-paid 21% excise tax on any remuneration in excess of $1 million paid to covered employees for the taxable year beginning after December 31, 2017. And I did want to point out here that it is a 21% excise tax, but that excise tax rate is actually tied to the corporate tax rate, which is currently at 21%. However, if there were a change in the corporate tax rate in the future, that would also change the excise tax rate. Okay? Remuneration is treated as paid when the rights to the remuneration are no longer subject to a substantial risk of forfeiture. So for any compensation you have where there's been vesting in the past, there's no longer a risk of forfeiture. That's when it's taxable, and that's when it's considered in this, you know, test for the $1 million. This remuneration is defined very broadly to include all wages paid to the employee during the year. So if you're a calendar year filer, essentially your W-2 compensation, and including pay from all affiliated or related organizations. So also including that deferred compensation when it becomes vested and no longer subject to a risk of forfeiture. It does exclude remuneration from qualified retirement plans and also any payments to a licensed medical professional for the performance of those medical services. So for example, if you have a chief medical officer who's a physician, but they're receiving compensation as the chief medical officer, so administrative pay, as opposed to clinical services, that remuneration would be subject to the $1 million cap or with respect to the excise tax. If that individual, however, let's say has half of their compensation because they're actually providing medical services in the system and receiving pay based on their clinical services, that portion of the pay would not be included. Okay, and for this excise tax, to the extent the excise tax is imposed on an individual that has pay coming from more than one employer, each of the employers is liable for their pro rata portion of that excise tax. All right. Lastly, just want to note that the tax reform legislation applying to tax-exempt organizations does not provide for any grandfathering of existing compensation arrangements or any transition period for the new excise taxes being imposed. So this is a little bit different than how it's treated for publicly traded organizations where there is a transition rule and some grandfathering. Okay, next slide, please. Okay, so then the second type of excise tax, and we're calling this, the golden parachute, if one of those covered individuals receives severance and the amount of that severance equals or exceeds 3 times a base amount, which we're going to define, that is considered a golden parachute. Once you hit that trigger, the excise tax then is imposed on payments greater than 1 times the base amount. So you need to get to 3x to trigger the excise tax, but once triggered, the actual application of the excise tax goes all the way back to the 1 times the base amount, okay? So, and that base amount is going to be the average of taxable compensation over the prior 5 years. Again, this definition of a parachute payment does not include compensation to medical professionals for performing medical services. And there's also a note that compensation to employees who are not highly compensated under Section 414Q. Okay. Now, before I hand the webcast over to Susan Sulis to discuss how the excise taxes are calculated, I did want to quickly remind you of a couple of definitions that are relevant to executive compensation at tax-exempt organizations to ensure we understand the differences and the overlap, if any. Next page. So real quickly, I want to go through these definitions to keep in mind because it's, as we've been talking with our clients about tax reform issues, there's been a fair number of questions about this. So the first bullet, we're talking about covered employees. This is that new definition relevant to the potential excise taxes under tax reform. And as we stated previously, it's the top 5 based on taxable pay for each year beginning after 2016. So just want to remind you that you already most organizations will already have or should be able to determine who their first 5 covered employees are. Okay, remember, once covered, always a covered employee. The second bullet point talks about disqualified persons, which is a definition under intermediate sanctions or Section 4958. And this applies to organizations that are 501c3s or C4s. Okay, so the excise taxes are applied to a broader group of tax-exempt organizations, but some of you are going to be very familiar with the intermediate sanctions in the Section 4958 definition. In that, a disqualified person is a person in a position to exercise substantial influence, specifically the top management and financial positions, plus other top strategic roles based on facts and circumstances. When it comes to disqualified persons, there's a 5-year look-back rule. So even though you might not meet the definition or the requirement for a disqualified person, let's say next year, you're still going to be disqualified for 5 years. A little bit different, though, from the once a covered employee, always a covered employee. And the last distinction I want to make has to do with who needs to be disclosed on the organization's Form 990 filing. Again, it's a slightly different definition. So the definition for Form 990 filing disclosures, officers, directors, trustees, key employees receiving over $150,000, and the 5 highest compensated employees and independent contractors. You also have to disclose former officers, key employees, and 5 highest compensated employees if they meet certain compensation limits. All right, so you might have to keep coming back to this page if a question comes up, you know, how does this impact who's being disclosed in the Form 990, who, with respect to who might be subject to reasonable compensation rules, et cetera. But for now, I'm going to hand it over to Susan, and she's going to talk about how the excise taxes are calculated and some executive compensation plan design considerations. Next slide.
I think we're there. Thanks, Betsy. So let's focus on the excise tax on severance benefits, because that's going to be a bit more complicated. And keep in mind that although the Act uses the term golden parachute, which in the for-profit world implies that the severance benefits are contingent on a change in control, in fact, this excise tax applies to severance under non-change in control circumstances as well. So don't let the golden parachute fool you. So to determine whether your organization might be at risk of paying this excise tax, the first thing you need to do is identify your covered employees and then calculate the base amount for each, as Betsy referred to that a bit earlier. This is essentially the average W-2 pay for the past 5 fiscal years. So if you're a calendar year filer, that's going to be fairly easy to do. If you're not a calendar year filer, you're going to have to look at the W-2 type pay and figure out what part of it applies to that fiscal year. You'll then want to calculate the value of all benefits, whether cash or non-cash, that would be triggered by a severance event. But remember, you can exclude any clinical pay or pay from qualified plans. So we would suggest you review not only your severance plans, but also any other plan documents, incentive plans, retirement plans, those types, to ensure that you capture all payments that would be triggered upon severance. And if benefits differ based on the reason for severance, for example, a change in control severance versus a non-change in control severance, then you might want to run your calculation under multiple scenarios. So once you've calculated the total value of the severance benefits, then you take that value and divide it by the base amount to determine whether the organization might be at risk for paying these excise taxes. And remember, as Betsy mentioned earlier, if the severance benefits are more than 3 times the base amount, the excise tax is triggered, but the excise tax is calculated and paid on all benefits above 1 times the base amount. So let's take a look at an example of how this might play out. Next slide, please. So if we look at let's look at 2 executives who have been identified as covered employees. The top chart shows an example of how to calculate the base amount. You'll see that we've averaged the past 5 years of W-2 pay for each employee. Notice, however, that despite Executive B having lower 2017 W-2 pay than Executive A, the base amount for Executive B is actually higher, in this case because the income stream is lumpy, and that's a technical term. But Executive B may have had a SERP distribution or may have had payout of a retention award. This lumpiness in the income stream could be due to any one of a number of things, but it can impact the calculation. So if we go to the middle box, in addition to calculating the base amount, we also need to calculate the severance benefits as shown in the middle chart. So in this case, we've assumed termination without cause, which would trigger 18 months of total cash compensation as cash severance. So if you look at employee A, you see base at $642, target annual incentive plan at $224,700. Add those together, we get total cash at $866,700. And in this case, we've assumed non-change in control severance of 18 months of pay. However, under this organization's plans, we've also assumed that this would trigger a payout of the current year's incentive plan at target and vesting of the CERP. And if your organization happens to have a long-term incentive plan, that plan may also have a provision for some level of payout upon termination. So if we add up the amounts, the total is pretty close between the two employees, but the implications are quite different. As you can see in the bottom chart, Executive A with the lower base amount ends up exceeding the 3 times multiple at 335% and thus triggers the excise tax. But the excise tax is calculated on everything above 1 times the base amount. So in this case, the organization would pay an excise tax of 21% of that 1.4 million, which is the amount by which the severance of 2 million exceeds the base amount of 600,000. Executive B, on the other hand, with the lumpy pay, does not trigger the excise tax. As you can see, the base amount ended up being higher for Executive B, and therefore the multiple, the severance as a percent of base amount, was lower. Next slide, please. Okay, so what should organizations be doing now to prepare? First, organizations need to come to terms with how to balance this new cost of doing business and the PR issues it might bring with it, with the continued need to attract and retain executive talent. We do not expect any organizations will be capping executive pay or perish the thought reducing pay to avoid the excise tax. However, you can already start identifying covered employees for 2018, as Betsy mentioned before. 5 of them are probably already known. They're the 5 highest paid from 2017. But you may pick up more covered employees in 2018 if someone new moves into the top 5. That could happen through promotion or a CERP distribution or other means. You should also start setting up a mechanism to track these covered employees ad infinitum, because once covered, always covered, even if terminated. Next, you should look at the compensation for the covered employees you have identified and ask yourself if any of the compensation they're receiving could be excluded, such as clinical pay or pay from a qualified plan. Also, is anyone on track to receive a CERP distribution or retention award payout in the near future? You probably should be aware of those coming down the pike and be ready to see if that will create any impact in terms of your vulnerability to these excise taxes. You then want to review your severance plan provisions, understand what's triggered upon termination, and don't forget to look at individual plan documents and employment agreements too. They may also specify treatment of awards upon termination. And then start gathering W-2 pay information on your covered employees and determine whether anyone is likely to trigger the excise tax upon termination. Employees who have had significant pay increases over the past 5 years may end up with a relatively low base amount, but a relatively high cash severance benefit, which would typically be calculated as a function of current pay, not the 5-year average, and therefore may be more likely to trigger the excise tax. Although it's not listed on this page, if you have a long-term incentive plan with a payout frequency that is less than annual, for example, some plans, we call them end-to-end plans, and they pay out once every 3 years before starting a new cycle. You might look at whether those payouts could trigger an excise tax and whether it might make sense to convert the plan to an overlapping cycle approach that pays out every year in lower amounts. Next slide, please. So you also want to consider whether a lump sum payment that would trigger the $1 million excise tax could be split across more than one tax year. Now, this could allow an additional amount to be exempt from the tax, but any unpaid amount still needs to be subject to a substantial risk of forfeiture. So let's take an example. Let's assume no other wages are paid during the year, just to keep it simple. If someone has a $5 million CERP distribution paid entirely in 1 year, and they would incur a 21% excise tax of $4 million. Tax on $4 million, sorry, a tax of $840,000. But if it's split over 2 years, the distribution, let's say it's split evenly, so we'll get $2.5 million per year, you would only incur the excise tax on $3 million of the amount, so $1.5 million per year. In the first year, you get the distribution of $2.5 million. We tax you on everything over $1 million. That's tax on $1.5 million. Same thing in the second year. So in fact, you're only paying tax in this case of $630,000. So if there is a way to split over a couple of years, that's a way to help minimize some of these taxes. However, again, just delaying the distribution won't help. The unpaid amounts have to remain subject to a substantial risk of forfeiture. Okay, next slide. Organizations also should pay very particular attention to situations where an executive is expecting a lump sum, and a couple of situations here can be very problematic. If this lump sum is now going to cause pay to exceed $1 million in a year where the other cash compensation might have been less than $1 million, this could result in an excise tax where there wouldn't otherwise be one. You might want to make finance aware of these looming situations too, to ensure that they are properly budgeting for them. That's particularly important with a great big CERP distribution. Another problematic situation can occur when an executive earns $1 million in lives. So a lump sum distribution to that executive might push them into the ranks of the top 5 for that year, earning them a coveted spot on the list of covered employees forever. Next slide, please. So despite the potential for paying excise taxes, plan design should not be driven solely or even primarily by excise tax avoidance. The business need and mission should be the primary driver. So if we look in the chart, for example, a lump sum signing bonus might still make sense if you're using it to help pay for relocation. But if it's being used to buy out an unvested CERP, then it may be more appropriate to think about making periodic payments and avoiding the excise tax. Similarly, lump sum CERP distribution, say at age 62, might still make sense if the organization is trying to encourage and reward long service. But periodic distributions, as in class year vesting plans, and I think Paul's going to touch on this in a bit, those may make more sense if the executive team has been discounting the value of the CERP that has a long vesting period. Many mid-career hires don't necessarily intend to stay to age 62 or 65, and therefore you're not necessarily getting the value out of your CERP. A lump sum severance payment might make sense. The organization wants to incur all of the severance expense in the year of termination, and there is no cash mitigation provision. But if there's no particular timing need with respect to the expense and the organization wants to mitigate cash severance, a salary continuation approach might make more sense. A lump sum retention award is appropriate when it's critical to retain the executive for the full retention period. And an interim payment might reduce the effectiveness of the award because the executive might take the money and run. However, if the retention period is a bit longer, an interim payment might still make sense in order to maintain interest. And you could do that over 2 different tax years. So now let's hear from Paul about things to think about if you want to modify the existing plan arrangements. Paul?
Thank you, Susan. On slide 14, so again, this is about modifying existing awards and arrangements. If someone is going to earn a benefit next year, you can always change the terms of your ongoing plan for future accruals. There's much more flexibility on that, and that's a separate discussion. But in the situation where someone has a lump sum benefit that they've earned in the past, but it has not yet vested and paid, if an organization decides it may make sense to modify that existing award or arrangement, it needs to make sure its actions are compliant with relevant federal law, 409A for certain deferred compensation arrangements, and 457F on certain non-qualified plans. So these deferred compensation payment may be subject to one or both sets of regulations depending upon how the award or arrangement is structured. So both of these sets of regulations allow for deferred compensation amounts to be excluded from taxable income as long as there is a substantial risk of forfeiture associated with that potential lump sum payment. So as a reminder, when that risk of forfeiture ends, that creates a vesting event where the employee now has a right to that income, and that income is then included in determining if an employee A is a covered person, and B, if there's a potential excise tax owed. Hopefully, 409 Cap A and 457F allow for the substantial risk of forfeiture to be modified by allowing for an acceleration of vesting, but not of payment on deferred compensation amounts. Payment has different, more stringent rules that we're not going to address here today. So a firm can accelerate the vesting of a deferred compensation award expected to be paid in a lump sum over a number of years. That's the biggest approach to take something that would have been a lump sum in 1 year and have had all the tax impact at once and then spread it out over a number of years. Such as vesting 20% of a future lump sum. If you had a future lump sum that you owed 7 years from now, you could vest 20% of it next year in 2019, 20% in 2020, and so on. This spreads the taxable income associated with the payment out over a number of years, potentially lowering or eliminating the excise tax payment. Of course, this is creating taxable income for the employee when the vesting event occurs. So you could help by distributing out just the portion of the now vested deferred compensation amount that is needed to pay those taxes. The remaining vested amount will be payable upon the original distribution date. An example of how this may affect the potential for an excise tax follows on the next slide. So on slide 15, next slide, please. We've got an example here of a person who their cash compensation year in, year out is under the $1 million limit. So this person in 2018, their annual incentive and their base salary, if you look in that first table, it's $700,000, and it grows a little bit over the next 4 years, but on its own, it would never be enough for this person to have excise tax payable if this is all the compensation that the executive receives, even if they're a covered person. Okay. This executive, in this example, they're eligible for a $1 million SERP lump sum payment in 2022 under the terms of their employment agreement. So this payment vests in full in 2022 and arises as taxable income in that time. So the second table, alternative 1, shows the excise tax implications of this one-time vesting event. So for 2018 to 2021, the excise tax test only includes the cash compensation paid in that year, since that's the only pieces that are taxable, and that's under $1 million in each of those years. No taxes owed. In 2022, when the $1 million SERP vests, this executive's cash compensation and SERP vesting total $1.8 million of income, which, if they are a covered person, means that $800,000 of their pay would be subject to the excise tax. So this is how the lump sum payment can cause there to be pay subject to the excise tax. So this organization could mitigate this potential excise tax payment by accelerating the vesting of that $1 million SERP over a number of years. For example, the last table on this page, alternative 2, the SERP is vested evenly over the next 5 years. This spreads the SERP into taxable income from 2018 to 2022. You see $200,000 a year in the table, And what that does is it results in, if you look at that total pay line, the executive makes $1 million or less in each of the next 5 years, and no excise tax is owed in this scenario. So we can move on to the next slide, please. Of course, accelerating a CERP payment has other implications for your business besides the excise tax, right? You may want there to be some sort of handcuff associated with this payment, for example, as Susan mentioned before. So, the other alternative, instead of accelerating vesting, if that's not the right approach for your organization could also modify an existing award by deferring vesting if the business and employee considerations allowed this to be a viable option. Again, whether 457F, 409 Cap A, or both sets of regulations apply will depend upon the terms of your deferred compensation arrangements. So, in the deferral scenario, 457F requires the amount to grow by 25% of the original present value of the payment during the deferral period. So you have to pay someone more. The deferral has to be for at least 2 years, and the executive must perform substantial services during that time. 409A rules are a little more restrictive. If the payment is subject to that, there's a 5-year delay required, and I'd say 409A is going to make this even more complicated if that applies to you. Now, note that delaying a lump sum from 1 year into a lump sum payment in a later year, that's not going to address the excise tax consideration on its own, right? If the employee's underlying cash compensation only grows over that time, all you're doing is creating more of a potential excise tax liability. Instead, that delay must either be combined with an effort to push the lump sum payment out into a year when the executive's cash compensation will be lower, such as a time when they might be a part-time employee, or it could be combined with a choice to spread, the delay could spread the vesting event into taxable income over a number of years. So you don't have to delay a lump sum into a lump sum. You could delay it into a vesting pattern that is spread out over a number of years. Again, given the requirement under 457F to increase the value of the benefit, the net cost of delaying vesting would need to be evaluated relative to simply vesting the benefit as is. Lastly, one should note that changing the vesting pattern, accelerating or delaying, changes the W-2 income of the participant, which has income when determining the base amount used in evaluating whether a severance payment is subject to the excise tax on golden parachutes. And finally, before I turn this back over, just wanted to remind you that, going forward, you could look at your future accruals and determine if there are room in your broad-based qualified retirement plans for more contributions to be made for the executives in lieu of, say, a supplemental executive retirement benefit or some other payment that is subject to deferred compensation rules. This is not a consideration that will apply to every organization, but qualified retirement plan contributions they're not income for the excise tax test. So that is another way to potentially reduce the liability. All right, back to you, Betsy.
Thanks, Paul. So the final topic we're going to discuss are communications issues. And we're going to give you some general thoughts regarding these, but I can tell you that folks are still trying to figure this out, get their arms around, what do the potential excise taxes mean for our specific organization. However, it's never too early to start thinking about the communications issues. And in this graphic, we have all your different, what we call stakeholders or audiences, etc., that may have different types of questions and often competing interests. And I think what the trickiest thing is about these new excise taxes is, there's an assumption from your donors, from just in general folks, that the funds that you have within your organizations are being used to support your mission. And there's a potential perception that initially incurring an excise tax is something that's somehow different and maybe, something that shouldn't be a use of your funds. That said, I do believe that over time, organizations and your stakeholders are going to get more comfortable that just as you need to pay market competitive levels of pay for the executives and the team of individuals who are enabling you to fulfill your mission, that it may come down to the point that it's the best business decision to pay some amount of excise tax. So going back to some of the issues that Susan highlighted, certainly be aware of the excise taxes and plan and think about what's the best way to deliver the pay so we can support our mission. But at some point, you may be that you're just saying, this is an additional cost of doing business. So for some of our largest, most complex organizations that are going to have individuals who may have a regular pay package that exceeds $1 million, and then when you add on things like CERP vesting, retention, leadership transition awards, these excise taxes may just be kind of part of business going forward. So if we can move to the next slide. Okay, so what the brief suggesting is an overview that you might want to think about now, again, as you're figuring out the potential impact to your organization. Defining your strategy. So how will the media reflect the new excise tax? I think, that remains to be seen, though, it certainly is somewhat of a interesting headline. So I think it will definitely hit the media. And should you proactively manage the message? What about social media and how can you manage that? And of particular importance, I think, you need to talk with your board and your leaders about your pay strategy so that they have an understanding and a common message regarding the pay strategy and what might be some of these potential excise taxes. So you define your strategy, develop your messages. We talked to a certain extent, this just may make sense going forward in some fashion. So it's an increased cost of doing business. I think that's something that, you just have to develop the messaging around that. Competitive pay is necessary to attract and retain your talent that you need to support your mission. Also explaining your pay philosophy and process to ensure that your pay is market competitive while making the best use of your resources. And then lastly, determine your communication vehicles. So be prepared on the public relations issues, maybe having some FAQs for your key leaders, targeting who will be addressing these questions, and consider using the publicly available information or vehicles you may have available to you right now, Form 990 filings, websites, etc. So basically, you want to ensure appropriate review and documentation supporting your pay levels and your approach to pay for your covered employees and all of your employees. And then confirm any associated communication strategy, particularly if your organization is likely to be subject to these excise taxes. Next page. So wrap up, we have 4 key messages that to remember from today, and then we'll go ahead and take questions if you have any more specifics. So what you should be doing right now is understand the potential impact to your organization. Okay, who are the covered employees, modeling projected pay, and severance benefits. Reviewing the existing awards and arrangements. So as you're modeling, taking a look at some of the things that you have out there, and as both Susan and Paul spoke to, look at some of those lump sum payments and do those make sense still? Is that the best way to deliver the pay, or might there be an opportunity to potentially restructure some of those while still getting the value of the arrangement that was put in place in the first place? Consider changes to your exec comp plans going forward. Obviously a little bit easier than changing the ones that are already out there. But again, using the same considerations, you know, what are we trying to accomplish and what's the best way to do that? And then developing the communication. So those are our key points. We've got about, it looks like 13 minutes or so for questions. So I'm going to go ahead and turn this over to Scott Becker, who's handling the Q&A session.
Thank you very much. I want to first thank the three of you, Betsy, Susan, and Paul, for a terrific presentation. I also wanted to encourage the audience to send in questions, type in your questions. I've got a bunch of them for you, so let me get started with that. But I do want to encourage the audience to write in questions, and I see a lot of people are doing so. So let me start with an easier question to get started. Is the excise tax paid by the employee, or is it paid by the system or healthcare entity? Who pays it?
So this is Betsy. I'll jump in on that one. Oh.
Thank you.
Betsy.
Oh, okay. I took the easy one. Susan, you can have the next harder one. So the excise tax is paid by the organization. So it's not paid at all by the person to pay triggers the excise tax.
Got it. So it's by the organization, not the employee, not the executive. The next question, which is a similar question, is a little bit different. Is the excise tax applied to public employers? The example given in the question was the University of Texas, but there's a lot of hospitals and health systems and big healthcare entities that are public. Cook County system, would they be subject to this too, or is this just for not-for-profits, commercial, private employers, et cetera?
Well, Scott, I think it will remain to be seen, but the way that the Act reads right now, it applies to any organizations that are tax exempt under Code Section 501. It doesn't limit which part of 501, so it's not just, unlike intermediate sanctions, it's not restricted to 501c3s or 4s. Now, if the public entities are not classified under 501, then I really don't know whether it would apply to them or not.
Gotcha. Thank you. That's a good answer. One of the things that's impressive is throughout the webinar, on a very complex topic that you've made very understandable for a lot of people, I think nearly 97% of the people stayed on for the entire webinar, which is really impressive for a complex topic. Let me ask another question. If an executive is part of the top 5 employees in 1 year, and then he or she drops out of that in the next year, do you still need to count that person going forward, or when do you stop counting that person?
I'll take that one again, Betsy. This is Susan. This is, you never stop counting. They are a covered employee forever. So if they get into that top 5 just 1 year because the CERT vested that year, and then they drop down, let's say, and they're never in the top 5 again, they're still a covered employee.
Got it. So once somebody's in it, you have to track them basically forever for this purpose.
Correct.
And another technical question, can you define taxable year? Let's say a system is a different fiscal year than a calendar year for their 990 purposes. How do you calculate this? And if it doesn't apply until October of 2018 for the tax year after 2017, how do you deal with fiscal versus calendar year? Can one of you answer that?
This is Betsy. I'll take a stab at that. So this is very confusing. I mean, we've had a lot of internal discussions about this, but the regs specifically cite that this applies to the taxable year, and taxable year would be your fiscal year. So if you have a calendar year, fiscal year, it's a lot clearer. it's the calendar year, you're basically looking at W-2 type compensation. But as Susan alluded to, if you're a fiscal year, which is not a calendar year, so let's say your fiscal year begins June 1, you have to calculate what is the pay within that fiscal year of those W-2-like items, even though it's not going to match W-2s because those are based on a calendar year. So, yeah, you're going to be tracking some additional type of compensation.
And let me ask another question on other types of compensation. And again, Betsy, Susan, or Paul, either one of you, any one of you jump in and provide the answer on this. Is deferred compensation in a 457B plan subject to the same excise tax?
This is Paul. The way a 457B works a little bit differently than a 457F or an underlying qualified plan. So when a deferral is made into the 457B, that is not an event that creates taxable income, right? Think about the tie to what's going on the W-2. So that is not an excise tax event. However, when money comes out of the 457B, it's showing up on your W-2, and that is an income amount that could be included in an excise tax test. So yes, the 457B will eventually be included in the excise tax test potentially, but it's going to be on the distribution side, not on the deferral side.
Similar to like a 401k, but for a not-for-profit, it doesn't count on the way in, but on the way out, it could.
Well, 401k shouldn't count on either side in theory. They've got that carved out.
Gotcha. So my mistake. I'm sorry about that, Paul. Let me ask you another question. If someone is vested, and the question was asked, executives had vested before 2018. They'd vested in their SERP before 2018. Does this mean that they're not subject to the excise tax?
Well, to the extent the SERP was previously vested, that would have showed up in their taxable income at the time of vesting. So for the previous accruals that were vested in years before 2018, no, those amounts are excluded from the excise tax. To the extent that the SERP has ongoing accruals, and again, in a vested plan, it'd be pretty common to have potentially, new benefits being earned every year, say. Those new benefit accruals would show up as income whenever they are vested. But the past is the past, and that's left behind.
Gotcha. And then another question related to SERPs. Can an individual become a covered employee, a top 5 employee, solely because of their SERP payout? Because it's so large in 1 year or what have you, not so much vesting that year, but paid out that year, or I guess vested that year?
Well, paid out, this test is all about taxable income. So payout isn't really the criteria. It's going to be on a 457F type plan. It's going to be when does it vest. So yes, someone who made, say, think about the example I had back on, what was that, page 15? Someone could be the 6th highest paid person at your organization, and it doesn't just have to be a SERP. If they suddenly vest into any sort of lump sum payment that makes them the 5th highest person, and now they make over $1 million, they could be a covered person going forward. And if they made over $1 million, that's subject to the excise tax, whatever the excess is.
Gotcha. And there's a similar question around parachute payments. There's a couple different questions about parachute payments. Let me try and ask one of you, or Susan, Betsy, or Paul, to tackle this. It's if a parachute payment is partially deferred or, in contrast, is accelerated, is that portion of the parachute payment included in the remuneration for the $1 million comp limit? So the parachute payment's deferred, one case, or it's accelerated. How do you calculate whether that parachute payment's included in remuneration for the $1 million comp limit?
Scott, this is Susan. I would think that you'd have to just look at when it hits the W-2 as taxable income. So if it vested and they're just simply deferring the payout, then it probably counts at vesting. If it doesn't vest for a period of time until payout, then it wouldn't count until it vests.
Gotcha. And then Go ahead.
Right. But this is Betsy. To that point, though, I think the question on, let's say that you have something that's not earned yet, because if it was earned, it would have been vested, and it's not an issue. So because of the severance, it triggers that it's now vested. It's a SERP, it's some sort of incentive payout, et cetera. Because there's a chance that it may not have vested, 2 years from now when it was supposed to vest or whatever, that would be included as part of the severance payment, because the severance is what triggered that vesting in the plan, even though it might have vested down the road. We don't know. Does that make sense?
Yes, I think so. Here's another question on W-2 compensation and how this is calculated for the excise tax. Is it calculated based on W-2 comp, or is it calculated based on Medicare wages for purposes of the excise tax?
So this is Betsy, and we're going to
thank you.
Caveat all these that, these definitely going to have to be talking to your tax folks too. But when we say W-2-like compensation, that is, we're using that term specifically because what you have to do is the intent. So the intent is to capture taxable income. So it would be your full income that's subject to taxes. It's not the only up to, the Medicare wage base or Social Security wage base, et cetera. It's what's your taxable income, but excluding qualified plan payouts and also excluding, pay for medical professionals for clinical services.
Yep. And Betsy, this is Paul. I want to add real quick. For a lot of your employees, the big difference between Medicare wages and W-2 Box 1 income is going to be, say, those qualified retirement plan type of benefits. So I would say for a lot of your people, Medicare wages is probably closer to Box 1 than it is to Medicare wages. Because, again, if you think about what's subject to FICA taxes, one of the primary differences are qualified benefit type plans that are excluded from this test. But as Betsy notes, there's other things like physician compensation and other matters that you have to adjust for.
Thank you. Let me also remind the audience that all the slides from this, which are just excellent, and I could say that because we didn't produce them, they were produced by Willis Towers Watson, those will be sent out to everybody who signed up for this, those that joined the call and those that signed up for it about a week from now. So everybody will get a copy of the slides as well. There's another question around golden parachute taxes for tax-exempt organizations. Are these calculated in a similar manner as they are for publicly traded companies on a change of control? Are they calculated in a similar way? Any insight on that, Betsy, Susan, or Paul?
This is Betsy. It definitely is a similar concept. The difference being it's not just the change in control. So, and also on a publicly traded organization, one of the trickier things there is the acceleration of equity awards, which aren't an issue for the tax exempt. So I think conceptually, yes, very similar calculation. You've got the 5-year average base pay. You calculate the tax due on anything over 1x once you've triggered by going over 3x.
Thank you. I've got one more great question. I know we're about to hit 2 o'clock. There's actually several questions, but I'll have Paul, Betsy, Susan follow up and look at those. We also have Paul, Betsy, Susan, and Paul's contact information on the last sheet of the presentation for people that would like to have that. There's a question on a practicing physician who becomes an executive and qualifies and then goes back to being a practicing physician, presumably within the organization, where the compensation would be excluded per the definition. How do you then look at the once counted, always counted rule? Is that question clear?
Mm-hmm. Yeah, it is, Scott. This is Susan. Because they were a covered employee at one point, they will always be a covered employee. Now, if they go back to practicing medicine, the clinical compensation is excluded. But that's not to say that sometime in the future they might not come back to an administrative role, in which case you need to look at that pay and determine if that's going over $1 million. But they will always be covered.
Or if I guess they had deferred comp that came to vest later
Correct.
on, or a parachute that came to vest later on, past their
Correct.
executive standpoint into the clinical standpoint. Got it.
Mm-hmm.
I want to do this just because we try and be sensitive to your time and to the listeners' time. I wanted to wrap up. Betsy, Susan, Paul, I mean, Willis Towers Watson, a magnificent organization, probably one of the top or the best-known actuarial firms in the country, and just tremendously thoughtful guidance here today. So thank you very, very much for presenting today. Again, people on the phone and people that registered will get the slides a week from now. I want to thank you all. Just a terrific presentation on challenging information, and the fact that the audience stayed on the entire time is a real testament to your making it understandable for people. So thank you very, very much, and thank you for staying on to answer questions. Betsy, Susan, Paul, we'll wrap up now, and I appreciate it greatly. Thank you.
Thank you, Scott.
Thanks, folks.
Thank you.